Ladies and gentlemen, thank you very much for tuning in to tonight's webinar. This is where we will explore the underlying trends that drive the performance of US residential market and the fundamental changes within the US home builder landscape. My name is Alex Lee, and I'm a community and event manager at iStocks, and I'm happy to be your moderator for this evening. So first, I just want to run through a typical disclaimer that this is not a call to offer and nothing in this webinar should be fully relied on. So who is GRT? GRT Asset Management focuses on undeveloped or partially developed land diversified geographically across US that is identified by publicly traded home builders for near-term development. Their management team comprises of seasoned fund management, real estate investment, asset management, and development professionals with a combined experience in excess of 50 years. And today we welcome from GRT Senior Vice President James. He is responsible for Southeast Asia regional operation based out of the Singapore office. James has been in the real estate management industry for over 12 years and is based in Tokyo, Hong Kong, and Singapore. Prior to joining GRT, James spent 8 years in Tokyo working in asset management, media, and telecoms. Joining us also is Vice President Sankar. He has over 12 years of experience in capital markets, corporate finance, and real estate. He has in-depth experience in acquiring and managing real estate assets across logistics, multifamily, and student accommodation sectors in Asia and North America. Now, for those who are new to iStocks, let me just share a brief walkthrough. At iStocks, our mission is to reduce barriers to private capital markets through a regulated, transparent, and community-driven platform so that underserved private market investors have equal access to all opportunities. If you join us as an accredited investor, you have access to private and non-conventional investment opportunities not commonly available in public markets. You will also be able to invest at a small minimum investment quantum and own fractional securities token, increasing your choices and help with portfolio management. Now, if you have any questions during the webinar, feel free to ask questions using the Q&A button below. And without further ado, I welcome James to kickstart the webinar. James, please.
Thanks very much, Alex. So good evening, everybody. Thank you very much for joining us. Sankar and I are very excited to talk to you about the US housing markets. For those of you that have been following the news recently, US housing starts are at an all-time high, 4.9% increase in starts in October, hitting an annual rate of 1.53 million, a number that hasn't been seen for almost 12 years. Additionally, builder confidence for home builders in the single-family residential market reached an all-time high, hitting 90 on the confidence index. So it's been a pretty tumultuous year. In the midst of COVID, we're seeing winners and losers. But why specifically is the US housing markets proving so resilient and strong in the midst of all of this crisis? So that's one of the questions I think we're going to try and answer for you today. Without further ado, I will hand over to Sankar, and Sankar will introduce a little bit of the background of the market to date.
Good evening, ladies and gentlemen. Thank you for joining us today. My name is Shankar, and I'm the VP of Capital Markets with GRT Asset Management. So like what James mentioned, the US housing market is now at a key inflection point and is poised for spectacular growth in the medium to long term. The main drivers behind the evolution of this asset class can be classified into three broad buckets. One, highly favorable economic and market conditions. Two, strong population demographics. And three, evolving business models of the key players within this sector. So during the course of this webinar, James and I will take you through the major developments in each of these buckets and how each of them have contributed towards making the US housing market an asset class that is simply impossible to ignore for investors globally. So moving on to the US housing market performance, the US housing market has been on fire since the start of the year. And this has proven to be one of the few bright spots within the real estate space. The strength and tremendous performance of the US housing market simply cannot be ignored, with the number of housing indicators hitting multi-year highs. Let's take a look at some of these relevant indicators. As of October 2020, the market has demonstrated the rosiest home builder confidence in almost 35 years. best spending home sales index in the past 2 decades, strongest new and existing home sales over the past 15 years, the hottest single family construction activity since 2007, highest new home market share, 13% since 2008, and the fastest rate of home appreciation since 2014. We're talking about an 8% year-on-year increase here. As the housing market basically leads the US economy out of the recession, it's important to note that the new home sales, the blue line you see on the chart here, is the main driving factor with a 43% year-on-year increase. The strength of the US housing market is in turn driven by long-term tailwinds that include one, highly favorable demographic trends, and two, record low housing supply levels over the past decade. Other factors that have played a significant role in the outperformance of the US housing market include short-term factors like record low mortgage rates, urban exodus in coastal cities, dawn of the new work-from-home lifestyle, and record levels of fiscal stimuli. We'll take a closer look at each of these factors in the next section of this presentation. The residential sector's resilience in the face of economic and market shocks is one that has been established historically. The current COVID situation has basically served to further highlight this resilience. As you can see from the chart on the left, which has been put from a report by Green Street Advisors and Nuveen Real Estate, the residential sector in the bottom left corner in the teal box has low correlation to economic and COVID sensitivities when compared to other more traditional asset classes like hotels, retail, and offices. This concept is further reinforced when we look at the chart on the right. It can be seen that while most traditional real estate asset classes like malls, offices, and multifamily lost significant value since Feb this year, single-family assets not only acted as a safe haven for value preservation, but also delivered the highest upside, almost 4% increase in value since February 2020. If we dive a little deeper to look at the performance of new home sales in the US, the double effect of record low mortgage rates, 30-year at 2.8%, and COVID-19 have basically pushed homeowners to move away from rentals and multifamily assets in core locations to basically buying single-family homes in the suburbs to be able to enjoy larger and more affordable living spaces that cater to both their families as well as the new situation of working from home. If you look at the chart on the left, new home sales in June 2020 have increased 55% year-on-year, and 57% of builders have been able to leverage the strong demand to increase net home prices. If I can refer you to the chart on the right, which is an excerpt from CNBC, across the US, new home sales improved across the country, with Florida leading the pack with an 84% year-on-year increase. It's important to note the double-digit year-on-year increase across all the regions here. So all this positive news and activity in the US single-family market is impossible to ignore and has drawn the attention of some of the largest institutional players. So if you look at the timeline here since earlier this year, in March 2020, POBA, the Korean insurer, invested US $120 million into a fund targeting US single-family investments. Brookfield followed suit in July 2020 with a US $300 million fund targeting single-family value-add strategy and acquired a controlling stake in Condrax, an operator. Blackstone, which had exited the sector a couple of years ago, re-entered in August 2020 with a US $300 million investment into Tricon. Nuveen, a TIAA subsidiary, in September 2020 announced a US $400 million investment through Sparrow, a vertically integrated single-family home rental platform. In October, most recently, JP Morgan and Rockpoint came in with sizable investments into the space as well. JP Morgan basically committed to a US $700 million residential development fund focused on the Sunbelt region, while Rockpoint deployed US $1 billion via a JV with Invitation Homes towards a value-add single-family strategy. It is important to recognize the size of the commitments from these institutional players and the pace at which this capital is being deployed. While the investments earlier in the year were relatively smaller and these investors were testing the waters, recent investments actually show significant commitment from these institutional investors towards both this strategy, and this also serves to validate the sector as a whole. It's important to draw parallels to what is seen in this sector and what we saw with other alternative asset classes almost a decade ago in sectors such as student accommodation, data centers, etc. When institutional money starts flowing into an asset class, it opens the floodgates, and you typically see cap rates starting to compress very aggressively, and opportunities for smaller investors to access the market start to get more scarce.
So now we'll take a little bit of a look at the fundamentals that are driving the growth in the US housing market. And hopefully by sharing this, you'll begin to understand why we're seeing the phenomenal growth we are today. So if we look at the US housing market over the past 50 years, the US typically builds anywhere between 1 million to 2 million homes per year. And it's a cyclical market. That housing supply is to meet the demand of population growth. The US adds around 2.5 million people every single year from net growth, as natural growth, as well as from immigration. And as a result, they require about 1 million homes per year just to meet the natural growth rate of the population, and then an additional 300 to 500,000 to meet the needs of homes that are damaged, old, need to be replaced, as well as some second home inventory. So anything below 1.5 million homes is effectively a shortage of supply. What we saw in 2008 was a massive correction in the housing market, a long bubble from 2003 all the way up to 2008, followed by a sharp correction. And it's been a very, very long and slow recovery up to the point that we are today. And if you look into the details, if you break down the residential construction that's occurred since the financial crisis, what you'll see is that the multifamily market recovered very quickly. The supply of multifamily pretty much hit the pre-crisis peak in around 2015, 2016. Whereas if you look at the single family, and by single family, we mean a single family detached home in Singapore, a landed property, single family starts really haven't recovered. And it actually makes a lot of sense. And if you look into the demographics of the population, you'll note that there is an incredibly large cohort of young Americans. And in particular, the demographic that we're interested in is the millennials. The millennials are roughly between the ages of 21 to 38. They number over 82 million. This is an enormous cohort. And this cohort, the upper end, they graduated in the middle of the financial crisis. They took a little bit longer to get on the career ladder. They've been renting apartments downtown. And as they've got older, they're beginning to get married, have kids, and that becomes the natural point that you look for a single family home. So it's not at all surprising that we saw a huge growth in the multifamily rental and the multifamily rental market over the past 8 years. And again, it's not surprising at all that now we're seeing massive growth in the single family market as these millennials get married, have kids, and look for their first home. So what's specifically driving these millennials to buy their first home? They've been looking towards buying a house for the last few years. We've seen millennials really begin to impact the housing market since 2018. But what's really changed is in the aftermath of COVID, these millennials are very, very acutely aware of the shortage of space in their apartments, in their downtown locations. And coming out of COVID, they want more space. They, in many cases, have been told that they can work from home. They may only need to come into the office a couple of days a week. And combined with that, mortgage rates are at a historic low. So now what we're seeing is young families moving out of urban centers towards suburban communities where they can buy a larger house, they can have an extra room for a study or a home office, they can have a much larger space with outdoor space, a yard or a garden, and they can enjoy these low mortgage interest rates to really make their home their own. And mortgage interest rates, a 30-year fixed rate mortgage right now is below 2.9%. In fact, the other day, a couple of days ago, it went as low as 2.78%. And what does that mean for the average American? The difference between a 30-year fixed rate mortgage at 4% and a 30-year fixed rate mortgage at 3% is roughly $300 in the pocket of an average American family with a $500,000 loan. Another way of looking at it is if interest rates at 5%, the average American family can buy a $279,000 home. But with interest rates at 3%, that jumps up to $355,000. So suddenly you have a large demographic that are feeling, that are seeing an opportunity to get on the housing ladder, and they want to grab that.
So we will move on to cover the next section where we'll talk about the evolution of the US home builders. Before we do that, to truly understand and appreciate the opportunities presented by this booming housing market, we have to understand the home builder landscape and who the key players are in this space. So there are approximately 2,500 home builders in the US. Most of them are small regional builders who focus on specific geographies and build anywhere between 50 to 60 homes a year. Then you have your large listed national home builders like D.R. Horton and Lennar, who build homes in all markets across the US and own significant market share. Then you have your listed home builders like NVR and Pulte, who focus on specific regions and has a significant market share within the sector as well. The smallest players come next, and most of these are publicly held regional home builders. Slide 17 shows the size of the various home builders to give you a perspective of scale. The size of the bubbles represent the size in terms of the number of new home closings that were held by the respective home builders in 2019. The orange circles are the publicly listed home builders, while the blue circles are the privately held ones. From the diagram, it's apparent that D.R. Horton and Lennar are clearly the whales within the industry, and they dwarf all the other players within this sector. In fact, D.R. Horton in 2019 built more homes than home builders ranked number 3, 4, and 5 put together. That's just how big they are. Now that we're familiar with the home builders that operate in this space, we can explore how the business models have evolved over the years. We shall look at it from the perspective of access to 1, land, and 2, financing, as these are the 2 key factors that affect a home builder's business model substantially. So in the gray portion, before the last housing crisis in the US, most home builders worked on a land banking model where they would typically hold land on their balance sheet for anywhere between 7 to 10 years until they decide to start developing the land. And they typically worked with more market-specific land suppliers. That means they'll be working with a couple of different land suppliers in Texas, a certain number of land suppliers in Florida, a few more in Southern California, for example. The financing environment was also flush with traditional lenders who offered high LTVs, which are loan to values, and relatively low interest rates. Post-housing crisis, the section that's highlighted in blue in the chart, traditional sources of financing basically dried up as banks were punished for financing illiquid assets in excess of certain thresholds. So non-traditional lenders basically stepped in to fill the void, but these lenders are generally those that are not really familiar with the markets and the home builders that the home builders operate in, and as such, they levied higher risk premiums for the interest they charge the home builders. So faced with a financing crunch, the home builders realized that they would have to adopt a just-in-time model in order to make better and more efficient use of their balance sheets. With the just-in-time model, home builders would not hold more than 2 to 3 years worth of land inventory on their books, and they would work with land acquisition partners who would typically acquire and hold the land for them until they are ready to commence construction. So this arrangement basically allows them to operate on an asset-light model, bringing the land assets onto their balance sheets just when they are just about ready to start construction. Hence, they started the gradual transition of moving from a pure land banking model to a hybrid model that encompasses both land banking and just-in-time models. And they started working with regional home builders to make the land acquisition process more efficient. Going forward, home builders will increasingly adopt a more asset-light strategy, and they'll transition to functioning on a just-in-time model for their land acquisitions. They'll also work with national partners who can supply land to them using a just-in-time model across all markets in the US. And these national partners they work with will also act as an efficient financing partner, since they can understand the markets and the associated risks intimately. So companies like GRT Asset Management basically operate in this new niche space. Slide 19 further highlights our case in terms of home builders transitioning from a land banking model to a just-in-time model. As discussed earlier, over the years, the large listed home builders have moved away from traditional land banking to a just-in-time model where they only hold up to 2 years worth of land inventory. What this does is it gives them greater flexibility in terms of cash flow and helps to strengthen their balance sheet and credit ratios. The home builders are also able to ensure their access to land supply by signing option agreements, which provide the home builders with the flexibility to bring the land onto their own balance sheets only when they're ready to start development work. So in the chart on the right, you can see that the top 5 listed home builders like D.R. Horton, Lennar, Pulte, etc., are moving towards a higher proportion of option versus own lots. So if you look at the chart, right, basically you can see D.R. Horton has most recently reported that over 66% of their lot inventory is controlled through option agreements. This is almost 260% up from the 2014 figure. For companies like GRT, this presents the perfect opportunity to address the gap that has appeared in the business models of these home builders. The next two slides serve to show how, basically to illustrate how the top large listed home builders are gradually moving towards a higher proportion of option versus own lots, i.e. Moving from a traditional land banking model to a just-in-time model. So the blue bars in the charts you see here basically represent lots controlled through option agreements, while the gray bars represent own lots by the respective home builders. So it can be seen that for D.R. Horton and Lennar, the larger listed home builders are generally moving towards a higher proportion of lots controlled through option agreements as opposed to own lots. When we look at home builders number 3 and 5, namely Pulte and KB Homes, the same pattern emerges with option land inventory gradually overtaking own land inventory. So how does this basically impact their financials? So here we take a look at the financials of the top 5 home builders to see how this transition in their business model impacts their cash generating capacity and their return on equity. So zooming in on D.R. Horton, when we look at the bar charts on the bottom right, we can see that the evolved business model basically results in strong increases in net operating cash flow over the years, as well as an enhanced return on equity for the home builder. When we look at D.R. Horton's leverage ratios, the purple and green lines in the chart at the bottom, it is apparent that the transition from traditional land banking model to the just-in-time model has resulted in a significant lowering of their debt levels and subsequently their debt to equity and debt to asset ratios. So what these better credit ratios basically imply is that when a firm like D.R. Horton now has to raise money from the capital markets, they are essentially able to enjoy a more attractive cost of capital. For example, about 3 months ago, D.R. Horton raised about $500 million of 7-year money in the capital markets at 1.4%.
Yeah, so as Sankar's discussed, there are various ways of accessing the US housing markets. There are home builders, big publicly traded home builders. You can buy their stock. D.R. Horton was an example earlier. D.R. Horton's stock pays a 1% dividend yield. You can buy D.R. Horton's paper. Their 5-year paper yields about 1.4%. But there are also alternative ways to get exposure to this growing housing market. And that is to work with an asset manager that works hand in glove with these large builders, basically to finance their land inventory pipeline through option contracts. It requires a very close relationship with the home builder. Home builders have pipelines of land. They conduct their due diligence. They then present those assets in their pipeline to an acquisition partner. Acquisition partners or the asset manager runs a second pair of eyes over the due diligence, confirms that the assumptions are all valid, and then a purchase and sale agreement is executed between the asset manager and the home builder for the asset manager to sell that property in phases to the home builder. That's done before the asset manager acquires the property. The home builder then assigns that property in their acquisition pipeline over to the asset manager. The asset manager holds that property. The home builder, number 6, they finalize their final engineering. And when they're ready, they break ground, put the infrastructure in, the roads, the water, the sewer, the gas, and then they start building and selling homes. As they sell those homes, the home builder will pay the asset manager for the land cost, providing revenue from the land sales. So if we look at a specific deal, it'll give you a little bit more idea of how this process works. So all the big publicly traded home builders, they have land acquisition teams that are out scouring the market for deals. They're typically looking for deals in proximity to their existing sales and construction teams in markets they're comfortable with. Once the home builder identifies a property, they'll put down some earnest money with the seller, and they will tie that property up, working with the seller to obtain all of the approvals, or what is known as entitlements, enabling that property to be developed. That can take anywhere from 12 to 36 months. And in the cost of getting those planning approvals and entitlements can be up to 46–50% of the property value. In this example, we're looking at $2.3 million being spent on a $5 million property. Once those approvals are in place, the home builder transfers the closing rights to the asset manager. The asset manager acquires the property and holds it typically for 6 to 10 months. During that period, the home builder spends more money on their final engineering, in this case, bringing the total spend on that property up to 60% of the property value. The home builder can walk away from this deal at any point in time. At this point, there is no obligation to proceed, but considering the significant amount of time, sweat equity, and money that has been spent getting this deal ready for development, it's very unlikely a home builder will walk. Once the home builder is ready to develop, they then take title to the property with a small down payment and start their horizontal and vertical construction. And then as homes are built and sold, payments are made to the asset manager for the land acquisition cost, providing revenue and investment returns. So what benefits does this structure specifically provide, A, to the home builder and then B, to the asset manager? For a home builder, they are able to secure land and lot positions that support their long-term growth strategy. And specifically, they can improve their cash flow by aligning the cost of the land better with the timing of the home sale. They're able to bring that land onto their balance sheet at the last possible moment, just before they develop the property, which massively improves their ROI and their financials. And the fourth attraction is by working with a scalable platform that can operate in multiple jurisdictions, the home builder is able to gain huge operational efficiencies. Whereas today they're working inefficiently in a fragmented market with different financiers in different regions, it makes it way simpler to standardize that process. From an asset manager perspective, it's very, very attractive to have a stable pipeline of assets with an exit strategy in place in collaboration with a large publicly traded home builder. Having the home builder take all of the development risk, all of the construction finance, all of the construction risk, the asset manager can really focus just on managing those land assets. It provides a stable cash flow, and more attractive is by accessing the market from this angle. There are some premiums that are able to be obtained to investors over traditional financing. So I'll hand it back over to Sankar, and he can summarize our views on the market today.
Yep. Thank you, James. So in summary, through this webinar, we hope we have impressed upon you how the single family sector in the US is an emerging asset class, which should feature in the portfolios of global investors who are looking to invest in an asset class which is 1, income yielding, 2, value preserving by nature, and 3, which acts as a defensive asset class with low correlation to market and economic shocks. The stellar performance of the single-family residential asset class can be attributed to the confluence of the following factors, as we have discussed. 1, favorable economic conditions such as record low mortgage rates and the after effects of COVID-19. 2, strong population growth and family formation trends amongst the millennials in the US. 3, a structural undersupply in the US housing market as a result of underbuilding over the past decade. And 4, most importantly, the evolving business models of the key players in the sector, which are driving efficiencies within the sector to allow it to meet the exceptional demand that has emerged over the past couple of years.
All right, thank you, James and Sankar, for the presentation. We've got quite a number of questions, so let's get started with the first one. So the first question by anonymous attendee asks, what type of investors should be considering investing into such a strategy?
I'll take this. So basically, the type of investors that should be considering investing into this strategy are those that want exposure to the US housing market. But like what James mentioned, those that want exposure to the US housing market without getting direct exposure in terms of development risk, but they want something a bit more conservative. but yet they want exposure to an asset class which is both income yielding, value preserving, and which is defensive in nature. So by the nature of the presentation that we have gone through, I think it is apparent how single family residential as an asset class is defensive and value preserving. And along the way, if you're able to work with an asset manager and invest into some of the products that they are bringing to the market, typically you're able to enjoy stable recurring cash flows on a significantly de-risked platform. So yes.
Thank you. Next question, we have, what are the benefits to the home builder to working with a land acquisition partner such as GRT?
I think we covered some of that earlier on, but really it's an efficient platform. If you look at the big publicly traded home builders, they have gone through a deep restructuring since 2008. There have been lots of mergers and consolidations, and the result is about 30 publicly traded builders with extremely lean, efficient balance sheets, efficient supply chains. The one inefficiency, the gaping hole in their businesses is access to land. The financing infrastructure post 2008, it basically got reset. And as home building has picked up, a very, very fragmented industry of expensive financing has taken its place. And now as we see housing starts really beginning to pick up, the opportunity to fill that void and offer a solution to home builders with an efficient platform and a simplified and efficient process is really, really key.
Thank you, James. That's a very interesting answer. Okay, next question you have. As a land acquisition partner, how do you manage the negotiations with large home builders who have bargaining power?
Yep. So I'll go with this, James. So essentially, it is very beneficial for us to be working with some of the large listed home builders, precisely as you mentioned, because of their larger bargaining power in the market. So which is why essentially when we are dealing with them, if you remember the process that James went through with you earlier, typically it is the home builder that is fronting all the negotiations with your land seller, etc. Because like what you mentioned, because of the stronger bargaining power within the markets, they are able to drive a harder bargain and get a better deal for us at the end of the day. But what we bring to the table to the home builders is also equally important. And I think what we have to understand when we are working as an asset manager with the home builder is the value that we are able to bring to the home builder and whether this is something that can easily be replicated by anyone else in the market. So some of the key factors that I think would really serve as differentiating us from other guys in the market who can offer something similar would be one, being able to support them on a national platform. So say for example, like I mentioned earlier, for some of these home builders, they're working with regional partners, like a couple of land suppliers in Texas, a couple in Florida, a couple in California, for example. What we are able to do is offer them a national platform. And effectively, because of our working relationships and our close understanding of the markets with them, we're able to give them what you would call a national plug-and-play platform. So essentially, since all your agreements are pretty much standardized and you've already gone through a set of deals with these guys, with the home builders in each of these markets, essentially they can just pick and drop any of the deals that they want to acquire onto this platform, and we can move ahead with it very quickly and efficiently. The other thing that, of course, we offer is the expertise in the respective markets that we operate in by virtue of our footprint in the US, as well as our expertise in terms of raising capital and understanding the risks involved in the various along the process of getting the entitlements, your final engineering works, and also we are able to run concurrently alongside the home builder. And I think that's a huge advantage for them as well.
And I think, yeah, that's a good question. There's always going to be a trade-off working with a big Goliath, one of the big public builders. They do have bargaining power. They are going to negotiate preferential financing terms, but that comes with the trade-off that you de-risk the platform. We could run this program with smaller mom and pop builders or smaller regional builders, and we could earn a higher cost of capital or a higher return, but you're taking on significant risk with that. So working with one of the big public volume builders, and if you look at any of the top 20 builders, if you look at their numbers in the middle of the financial crisis, these guys were still delivering significant home sales even in 2008, 9, 10, 11. So you de-risk the platform significantly by working with these guys, but you're not going to earn as much financing their deals as you would if you went with a smaller regional player. That's the trade-off.
Great. Hope you guys answer their questions in real detail. Thank you for that. We got a question now from Ting Yong asking, what is the tax implication for Singaporean investors?
Yep. Do you want to take that one, Sankar?
Yep, sure.
Yep.
So for Singaporean investors, basically there are different kinds of structures that typically the investors would have to invest through when they are looking at such strategies. I'm talking generically here, of course, but there are some debt-related structures, as well as some structures that would involve investors participating in funds that are being offered by some of these asset managers. So I think the tax implications are going to be varied depending on the structure, where the fund is going to be domiciled in, what are some of the tax treaties between the domicile jurisdiction and Singapore, etc. But generally, I mean, some of these debt-related deals are going to be a lot more tax favorable because of some of these other exemptions that you would typically qualify for, as opposed to investing via a fund. But investing into a fund has its own a separate bunch of benefits as well, including a diversification of a portfolio of assets, significantly de-risk it, prevents over concentration, etc. So it's a fine trade-off between the kind of structure that you're looking at, where the fund or the holding structure is going to be located in, and what are the tax implications of that for investors that are going to be based in Singapore. So it's a bit of a question. It's a bit difficult to answer without going into any specifics.
But maybe, I mean, the role of any asset manager, particularly dealing with US assets are going to be subject to US taxation. So the role of any asset manager is to structure these deals so that there's minimal tax leakage. And as Sankar mentioned, there are various ways of achieving those goals. But ultimately, the aim is that a Singaporean investor does not need to worry about any tax outside of Singapore.
Now, the next question is from anonymous attendee. Mortgage rates continue to remain favorable, but do you think this could be a recipe for another housing bubble?
So I think that's a very good question. We know housing markets are cyclical. And at some point, we're going to have an oversupply and things will get ahead of us. We're not seeing it right now. And part of the reason is there's been a shortage of supply for a number of years. So right now, the demand is massively outstripping supply. And what happens when demand outstrips supply? You see prices rising. And if anyone logs onto Google and checks US home prices, you'll see this year, in the last 6 months, we've seen about 6% home price appreciation, which is phenomenal. So the demand is there. If the home builders can build it, they can sell it. Right now, they can't build it fast enough. And I think what we're going to see is low mortgage rates. The Fed's committed to low rates for at least 2 years. It's unlikely that they're going to aggressively raise them straight afterwards. So we're probably in a low rate environment for a while. And there's a lot of home buyers out there that are in the queue. And maybe one point to note on lending standards, because there are so many buyers in the market today, the banks are tightening their lending standards. So right now, only the highest qualified borrowers are able to get a mortgage, and people with usually they would have no problem qualifying, but there's just so much competition. The banks are just taking the gold-plated borrowers. So there's still a long way, I think, for this to run before we see signs of overheating.
Yeah, and if we actually refer to the previous housing bubble, I think the main structural factor that basically led to that whole housing crisis was the fact that lending standards weren't as tight, and people were typically borrowing on several different properties at any given time. So like what James mentioned, current lending standards by the banks and all have tightened significantly, where you have to have very good credit scores, and they would typically frown upon anyone who's going to be buying multiple properties and all that. So I think the banks have actually learned their lesson from the last housing crisis, and they're applying those to the current situation right now. And because of the tighter lending standards that are under more scrutiny, I think I mean, having a housing bubble just because of people snapping up as many properties as they can, I don't think that's going to happen. But like what James mentioned, eventually when there is a situation where the supply exceeds your demand and all, and I think that that could eventually end up playing out, but it's not going to be because of your lending standards and what I would call indiscriminate buying during the last housing crisis.
And we expect policy to be favorable in the medium term. If the incoming Biden administration is going to be looking for ways to rebuild the US economy, and it's looking for non-inflationary ways of rebuilding, which means they need to supply underlying demand. They don't want to create, they don't want to be oversupplying. So the housing market, it's a very good place to start. If you build one home, directly or indirectly, you're supporting 20 to 30 jobs, everything from the painters, the plumbers, the tilers, the framers, all the way through that value chain, the real estate brokers, insurance companies. And of course, when people buy a home, they buy flat screen TVs and sofas and so on. So it's the US housing market can contribute significantly to US GDP. And it's a very good place for the federal government to rebuild that US economy as we come out of COVID.
Great answer, great and long answer. Now, I think we left with a couple of minutes. I think there's a repeated question about COVID. So with increased COVID cases in the United States, will this affect people deciding to purchase new homes? And another question, so let's join these two questions together. The other question says that, how will these prices hold up if the COVID vaccine succeeds and people start returning to work?
So I think we can share this, Sankar. So what if we look back at March, April, so the housing market went into lockdown in March and April, and you saw the visitors to the show homes in these new communities really dwindle and dry up. Then what happened coming out of that lockdown, you saw visitors, the visitor count to these communities spike. And what was interesting was not only did the visitors to communities jump, the conversion rate, so the number of visitors that actually ended up signing a contract to buy a home, that conversion rate also increased rapidly. And we've basically seen in the intervening months a pretty high visitor count, but more than anything, we've seen a really high conversion rate. So what that means is the people visiting communities, they're really serious about buying a home. They want more space. So if we have another COVID spike, I think we'll see the same thing. We'll see numbers dry up in the short term, but that pent up demand eventually gets released once people can get back out. And maybe you can answer that, Sankar.
Yeah, James. So I think in addition to what you mentioned about the trends, I think the underlying factors that are contributing to these trends, I think those have to be understood in order to be able to draw a meaningful relationship between both. So like what we've mentioned and highlighted in the presentation, and it might sound like we're repeating the same argument, but essentially what you have is a structural undersupply problem over the past decade. And what you have right now is all this pent-up demand that's being released into the market. Like what James mentioned earlier, a lot of the millennials who graduated during the last housing crisis were usually settled with a lot of debt, were not really able to afford a home, and they were just waiting on the sidelines, or they were renting shoebox apartments in multifamily apartments in downtown locations and all. And now basically what has happened is, with your mortgage rates at their current levels, at your ultra low, record low mortgage rates, and with their new norm of being able to work from home, I think it has all served to catalyze that entire process a lot quicker, and basically bringing up the demand a lot faster than it would normally have done so. And I think it has contributed very well to the single family sector within the US. And I think we're seeing that in terms of the new home sales, and like what James mentioned, not just the number of people who are visiting these new homes, these demo homes, but those who are actually committing and following through to actually buy those homes as well.
So obviously getting a vaccine to COVID is going to be great for the economy. But I still think it's going to take time. The economies are not going to open up overnight. We're not going to be going back to flying around the world on holidays immediately. So people are still going to be spending a lot more time at home over probably the next at least 12 to 24 months until a vaccine can be widely deployed. And if you look at what people do when they spend more time at home, they spend more money on their home. They want to buy a nicer home, or they're out at the home center buying wooden decking and putting plants and things in. So I think we're going to see that trend for the until we've got a widely deployed vaccine and things have settled down, we're going to be spending more times in our homes.
Yeah, I completely agree with you, James, on that. I am guilty of redecorating my home with a lot of wooden decorations and stuff that we bought online. All right. So
all joys.
We have one last question. I think right now we're saying that this industry is growing and there's a lot of opportunities. I think that one of the key concerns of our attendees is what are the risks that they should be aware of.
So in terms of risk, like what we've covered so far, I think one of the key risks that investors should be mindful of is in terms of when they're typically making an investment into this particular strategy or asset class. I think it depends on the angle in which they're going to be going into it from. If they're for example, if they're going to be going into it from a debt angle, then they should be aware of certain risk factors like your interest rate risk, and how when some of these interest rates eventually start rising after the medium term, how they're going to be, how the particular strategy is going to be reacting to that particular spike in the interest rates, for example, and how that is going to translate. If they're going to be investing more into asset-specific deals, for example, I think what is key for them to understand is the market demographics, things like your job growth, your affordability within those markets, your demand and supply pipelines within those markets, how many homes are being built versus how many guys are actually buying up those homes, etc. I think those are key factors that they would typically have to consider. Other than that, if like what we mentioned, if they're going to be investing into one of these asset managers, for example, what they should be aware of is who are these home builders that these asset managers are working with, and what are their risk profiles. Like what James mentioned, some of these asset managers might be working with home builders with a higher risk profile just to drive a higher return, for example. But investors should be aware that with higher risk comes higher reward, and they should be aware that of the credit profile of the home builders that these asset managers are working with, and how that translates into a reasonable risk-adjusted return for them.
Yeah, I think that's, just to reiterate, that's key, because ultimately, if you're supplying land inventory to a big to a home builder, you've got to have confidence that that home builder has the ability to follow through. So really understanding the home builder's balance sheets and their business model, and you can really quantify their risk. You can see their public paper. So really, we're trying to achieve a premium over their debts in the market by providing them a slightly more flexible form of financing for their land. So I think it's key to look at who the end user is and look at their track record.
Thank you very much, James and Sanka. We've now come to the end of the Q&A portion. Thank you very much for joining us tonight. I look forward to seeing you all in future events.